Well, good afternoon. Hope everyone's doing well. It's 4 o'clock. We're going to start on time. First, I want to wish everyone a happy new year and hope 2024 is off to a great start. So today we're going to spend a little bit of time just discussing our outlook for the year ahead. And hopefully you'll get something out of us. Hopefully it won't be dry and boring and you'll be falling asleep, which I don't think is the case. But anyway, let's get started. Here we are. First thing is a quick disclaimer. For those of you who have attended these sessions in the past, you realize that any forward-looking statements we make are just that. They're our best guess as to what we think conditions might be. Please don't take anything we say as specific advice to you and your situation. We encourage you to consult with us individually or a qualified advisor before you act on anything and such. So I want to start with, well, first of all, let me just say, if you're in the Raleigh area, there's a lot of pretty nasty weather going on right now. High winds and such. And so I just want to preempt this by saying, if we lose power, I apologize. If we do, we'll record the whole thing again and send it out so you can watch it. But that quick disclaimer there. So I want to start by rewinding to the beginning of 2023. And I think that's important because I find people tend to always just be forward looking, worried about the concerns ahead, trying to figure out what's going to happen without really reflecting a lot on the conditions that were present that created the result that happened. So in 2022, we had a really, really difficult market year. So we started 2023 after having, the S&P down 18%. The NASDAQ, which is more tech heavy, was down over 32%, and really just across the board red all over. This was the trend that happened. This is 2022, a clear downtrend. And there wasn't honestly much to be excited or rosy about. So we entered 2023 with you see my lights flickering already? I'll tell you. We'll be lucky to get through this. We entered 2023 with a list of a lot of concerns, and there was a lot of fear. Some of them were the fastest pace of interest rate increases in history had occurred. There was also war in Ukraine. There was also persistent high inflation. Recession fears were just all over the place. And this wasn't the beginning of 2023, but if you remember the early spring, we had a regional bank crisis where there was worries about banks failing and whether deposits were going to be okay. So there was a long list of concerns. What that did is it really affected sentiment. Now, sentiment is just a fancy word for how people were feeling. And if you've followed us for any period of time, that's one of the indicators we tend to look at is that what is investor appetite? How are people feeling? And what was amazing is at the time, sentiment was essentially the lowest they had been, even slightly lower than the great financial crisis of 2008, 2009. In December of 2022, 85% of economists predicted a recession in 2023. I'm going to repeat that again. 85% of economists predicted a recession in 2023. So let that sink in. All right, sentiment, that manifested its way all the way through, it's not just investors, but all the prognosticators, the people who are in charge of large financial firms, the market strategists and such. When we went into that year, the S&P value going into the year was at 3840, and you see that the large bulk of these people really thought the market would just kind of be flat. And if you listen to actually what they were saying, most of them thought we had further downside ahead and we might end the year on an upward trend and get back to neutral or maybe a little bit above. What actually happened, to some might think, is pretty staggering. 2023 was a really great year for the markets. The S&P 500 was up over 26%. Okay, some of these other indicators, the NASDAQ up 44+%. The international markets up almost 19%. The real estate markets up 11%, and bond markets recovered, although not quite back to where they were in 2023. So if you look at all the projections of everyone that laid out their best guess as to what was going to happen, essentially everyone on the street was wrong. Even the most bullish person on the list, okay, technically still wasn't high enough. And I remember a year ago, Tom Lee of Fundstrat, who was the highest estimate on the street, was getting lambasted for how ridiculous his claims were. So last year, again, rewinding a year, we gave a presentation about the same time, focusing on what we thought the year ahead is. I'll caveat by saying we don't do prognostications on what the S&P value is going to be or how much we're going to be up or down. I find that relatively useless, to be honest with you. But I do think we try to understand the conditions that are present and where things are going. So this is a screenshot actually of that presentation. It's still available on YouTube and on our website. We felt that if inflation had peaked in 2022, that turned out to be, that was right. We thought that the market lows in October of 2022 were the lows of the bear market. We felt that the economy had been resilient and would probably avoid a recession. And if we did have a recession, like 85% of people said, we thought it wouldn't be very severe. The bond market was predicting that the Fed would pause rates at some point in 2023. They did pause in 2023. It was actually probably a few months later than I thought it was going to be, but regardless. And this was the big one. This is the one that I remember telling people this, and I got some flack for it. Probably some of the people on this same call, that because everyone was so bearish, everyone was so lined up in one side of the boat that we were headed for recession and something was going to break in the economy and the market, that because people were positioned that way, there could be a pretty good whipsaw the wrong direction because everyone's on one side of the boat. And I think that's actually what happened. And then we said that we felt that equities could have a strong positive year. Now, I don't share that. I want to be very clear. This is not us trying to take a victory lap or anything like that, because we could be dead wrong about the future or anything, because no one really knows. But I share that to say that, the lessons that we learn from the past have to be applied to the future and how we make decisions. And here's the lessons I think that we should all learn from 2023. Number one, beware of consensus. Anytime there's broad consensus about anything in economics and markets, etc., it's probably a time to be wondering what the opposite of consensus is. The other thing, and I'm going to share this with you in a second, markets are volatile. We need to expect that. Okay? If you look at history, this is a chart or a graph showing annual market returns, okay, sorted from the worst returns to the best since 1900. And what you see is that a very, very, very small percent of the time, those annual returns are between -5% and 5%, or somewhat muted. Whereas Look at 51% of the time, okay, annual returns have been higher than 10%. I don't know how many times I've heard somebody say, "I don't, market returns at 10%. That's just ridiculous." Maybe, maybe not, but I'll tell you, history shows that 51% of the time, an annual return of 10% is likely. Okay, and on the other end of the spectrum is expected big downswings. So stocks either go up a lot or down a lot. And if you don't get anything else from what we share, is that when you invest, particularly for retirement, for the goals that you've set forth, you have to understand and be willing and know that you're going to experience volatility. It is a normal part. It is how markets work. Okay. Another lesson: don't get emotional. That's easier said than done, I promise. We've shown this chart before. This is a cycle of emotions, and what tends to happen is, as markets go higher, okay, the excitement builds and it turns into thrill, euphoria, etc. And then when markets start going down, the feelings follow. Okay. Price and the market price determines your sentiment and your feelings. It is not the other way around. The way you feel about your money is based upon whether you see it going up or going down. And then the last lesson from 2023 is you have to let compounding work. When you make decisions about whether to move money around in certain areas based upon what you're hearing in the media or what you think might or should happen, you are cannibalizing and you're completely cutting off your ability to let compounding work for you. All right, so enough about 2023. That's all in the past. What about 2024? What comes next? Well, as with any year, we can list a lot of concerns. We're still dealing with the fastest pace of interest rate increases in history, and we haven't probably seen the full effects of that. It's got to work its way through the system. Our stocks overvalued now. We had such a run up, especially second half of last year. Our stocks now, are they overvalued? We'll cover that too. Recession. Let's not take a victory lap on 2023 that we didn't have recession, and maybe that just kind of got pushed into 2024, and that's the year that we're going to experience recession. We're dealing with a war in the Middle East, and what are the byproducts of that? And if that starts to spread and get bigger and draw more and more people in, what impact could that have? And then there's a presidential election this year. What could go wrong? The last one was pretty sanguine. So there's plenty of concerns, as there always are. So let's talk about some of these, and then let's see where that leads us. Interest rates, where are they heading? So the Federal Reserve, one of the reasons the market really sprang up in November and December of last year, a few months ago, was because essentially we were waiting on the Federal Reserve to kind of indicate that they were done raising rates, that they were going to stop, that the rate increases were done. And we pretty much got that. And so the markets took that as, hey, all clear, off to the races. Now, did they get ahead of themselves? Maybe, maybe not. But let's look at where rates are likely to head, because that's going to help us determine what the economic and market impact is. So this is the December projections by the FOMC, the Federal Reserve, on where they see rates heading. So we believe we've seen the peak in the Federal Reserve interest rate increases, okay? And the market is now pricing in cuts in 2024 from the current levels. Now, in history, what tends to happen when we start going through a Federal Reserve cutting cycle? Well, it kind of depends on what happens with, whether there's recession or not. And so the Fed could cut interest rates for a number of different reasons. But if they trigger a recession, they're going to get much more aggressive in those cuts, because that's a stimulative way of trying to reinvigorate economic growth. Well, if there's in history, if there has been a recession and there have been cuts, then you see that's what this lower kind of teal looking line is here. Okay, so the months after the first cut, you see what the market performance has been historically. So not terribly bad, but it is down. So down 3 to 5% or so. Okay. Now, in a soft landing environment, which that is the environment I believe we are in, I do not think that we are headed for recession. So if we're heading for a soft landing, which is just the term used for slowing the economy down with interest rate hikes without creating, recession, then look at what historically has happened to market returns after the Fed starts cutting rates. And historically, what you see is, 6 months, 8 months, 10, 12 months after the first cut, which we're likely to see here probably maybe in March, you see that market returns are very good. All right. And so the average returns after cut are still positive. One little antidote to tuck away in your quiver. Are stocks in a bubble? And so I want to cover this as well. Anytime we talk about stocks being in a bubble or overvalued or something, there's no shortage of doomsday predictions that come out of the woodworks. And I'm going to pause and take a little bit of a detour here for 1 second, because this is a question we get all the time. Inevitably, somebody will email me or call, or they'll send me a screenshot or something of a headline that popped up on, you name it, news source. And they all tend to be very similar, right? They look, have things like this. These headlines here are all from like the last 6 months, okay? This one in the center, I'm going to hit here specifically, because this one, several of you on this webinar sent me this. I think on Fox Business, there was an interview done, and an economist named Harry Dent said that 2024 will be the biggest single crash year in our lifetimes. And of course, when you see a headline like that, it should make your ears perk up and go, is this something to look to? But these doomsday predictions occur all the time, okay? Here are our historical doomsday predictions, and then you can tell me whether they came true or not. In 1998, the cover of Fortune magazine, can the U.S. economy hold up the great crash in 1998? 1998 was a pretty good year for stocks. In 1979, Business Week magazine, headline, The Death of Equities. Guess what? The 80s were great years for equities. In 1987, New York Times bestseller by Ravi Batra. You can actually still buy this book on Amazon, believe it or not. Titled The Great Depression of 1990. Guess what? The 90s were pretty good years for the economy and for stocks. Bold predictions have occurred since the dawn of time. And what kind of gripes me is that no one ever holds anyone accountable. You just hear these bold predictions, then it just kind of fades away, and then you hear another one, and then it fades away. So I decided, let's kind of look at this latest one, this Harry Dent bold prediction that 2024, remember this one here in the middle, 2024 will be the biggest single crash year in our lifetimes. I was like, I don't know who Harry Dent is. He's an economist. He's published. Let's find out. Well, when I started looking, okay, he's been doing this a long time. So if you look here, right, he wrote a book. Okay, he wrote a book published in 2009, interesting timing, called The Great Depression Ahead, How to Prosper in the Debt Crisis of 2010 to 12. Go back and look at 2010 and to 12. We were coming out of the great financial crisis, and actually a pretty good time to invest. Okay, then here he is again. This is June of 2017, a once-in-a-lifetime crash coming in the next 3 years. I mean, I think we're past 3 years. Okay, was he forecasting 2020? Yeah, we had a pretty steep sell-off in March of 2020. I don't know that he was forecasting that. I mean, that's a once-in-a-lifetime crash. 2011, the Dow could crash to 3,000 in 2013. Here he is in 2016. Economist Harry Dent predicts once-in-a-lifetime market crash. Says Dow could plunge 17,000 points. You get my point. So these types of bold predictions and fear-mongering, I would caution you, right? Even, okay, you know, some of these here. So Stanley Druckenmiller, for those who might know, he ran one of the most successful mutual funds of all time for a number of years. He's a very credentialed, smart investor. He was wrong. Michael Burry of The Big Short fame, if you've heard of him, right? Essentially kind of correctly predicted the fallout of the 2008 credit crisis. In August of this year, he said he essentially made a $1.6 billion bet, a short bet, that the market would crash. The market has done extremely well since August. And so if he really did that, he lost a ton of money. Okay. So this guy's the worst. Robert Kiyosaki, the Rich Dad Poor Dad guy. You know, he's on this first list here. Just in December, this is like a couple weeks ago. Bank credit just sold off like 08. Get cash out of banks as you need cash. Maybe the start of the biggest crash in history. Okay. Well, again, if you hold these people accountable and you look at stuff he has said, he's been wrong for a long time. And so I essentially call some like him and some of these people, they're financial charlatans. They are promoting fear in hopes that they generate clicks and attention and such. And so as investors, as people who are focused on long-term goals and objectives for you and your family and such, you have to block this stuff out. All right. So, but let's cover, I never really did cover our stocks in a bubble. Well, one of the reasons people say our stocks in a bubble is that if you look at if you take the S&P 500, okay, which is just the collection of 500 of the largest US stocks, the percentage of, say, the top 5 companies in that S&P 500 is very large, right? So, I mean, Apple represents 7.5% of that entire index, okay? And so one of the arguments people will make is that there is such a disparity about these top companies at the top that are holding all the value, that there's, hundreds of other companies that are not getting the same attention. Well, again, I like looking at history, and I wanted to see is this abnormal, or is this a time where this has never happened before? And what's really, really interesting is that if you look at this top chart, this is the largest 10 companies, okay, as a total of their market cap, or the size of those companies. And what percentage of that is, are those companies of the total market? So what you see is that the largest 10 companies today, which represent, 27% or so of the total market, are actually still less than, okay, back in, this 40 or 50 year period, okay, from the 1920s to the 1960s. So that argument doesn't really ring true. If you look at the largest 5 companies, right? So Apple, Microsoft, Amazon, Google, those. Today, those largest 5 companies represent somewhere around 22, 23% of the overall market. Yet again, back in that same time period, it's essentially the same or higher. So I don't think the argument of there's a few companies that are propping up the market, or that there are a few companies that they're so much overvalued that they're in a bubble, that just doesn't hold water when you look historically. Okay. The other consideration that, and if you don't see any other charts I show you today, I want you to think about this one. When I saw this, it blew me away. Okay. So this is a chart of essentially all of last year. Okay. Which is like, since the October 2020 low. Okay. And this is showing the flow of where money is going. So investment money, where's it heading? Is it heading into stocks or equities, as defined by equity mutual funds and ETFs? Or is the red here, this is bond mutual funds and ETFs? And this line here, this is essentially money market funds or cash. So I want you to think about this. Since the October 2020 low, there has been huge inflow, okay, of money going into cash or money market funds. There's been net outflows, money coming out of stocks over that same time period, to the tune of $240 billion of net outflows from stocks. And then bonds, there's some net inflows. The market was up over 20%, and you had net outflows of cash from stocks. And so, and I don't know if you've seen some of these researcher articles out there, but the amount of cash that is on the sidelines today is enormous, historical highs. And that's evidenced by what we're seeing right here. And so all it takes is a little bit of shift in portfolio positioning for institutions and hedge funds into equities, and guess what happens? Stock prices go higher. This is, to me, this is probably the most meaningful chart for where we might be heading that I'm going to show you today. And this to me is a very, very bullish sign. If we saw tons and tons of inflows into equities, that may start telling me that we're getting a little overbought, or maybe there's a little bit, if you look at the cycle of emotions, right? We may be getting it close to that exuberance or euphoria period. I don't think we're there. And this is evidence of it. Okay. So one of the arguments I sometimes hear is, well, we had such a good last year. You're not going to have 2 good years in a row. The market's probably going to come back a little bit. Maybe it's going to be flat, whatever. So again, let's kind of look at some history here. What usually happens after a market year that's up over 20%? Well, here are all the years that the market was up over 20% since 1950. And then look at the following year. Yes, there's some down years, but the majority of years are green. Okay. Now, are they more than the prior year? Right? In each case, the only case that was higher the second year after that 20 plus per game was in 1996. But if you look at every other year, okay, with the exception of 4, the market was higher. A lot of them were double digits. But it's probably not likely to expect a higher return than last year, historically. But there's very good evidence historically that we could absolutely get a second positive year in the market. So what would be driving continued market growth and advancement, economic advancement? You know, I've done this long enough now to kind of see a lot of, several different cycles. And I remember the internet and the dawn of the internet and how no one understood it. I didn't understand it. I kept hearing this is going to revolutionize the world. I had no idea what people were talking about at the time. And lo and behold, what happened? The internet just changed everything about the world. And so you have this super cycles that have occurred with various technological advancements. Right now, we're seeing the infancy and the dawn of artificial intelligence. And it's here to stay, and it is a big deal. And so looking forward, if you're gonna say, Nick, what are some of the catalysts for continued growth in the economy and the market going forward? I want to tell you that the advancement of generative artificial intelligence is one of the main drivers. And we're starting to see that. People are starting to understand and believe it now, especially with ChatGPT. If you're not familiar with ChatGPT, you need to figure it out. It's amazing. But with the introduction of that, I think it clicked for a lot of people. Wow, okay, I see now where this artificial intelligence is taking us. So I do think we're in a bull market, and the artificial intelligence super cycle is upon us, and it's going to trickle down in a lot of areas. All right. So, what about the election? There is an election this year, and how will the election impact the markets? If you can tell me what's going to happen in the election, more power to you. I don't have a clue. And I know there's a lot of people that are kind of on pins and needles wondering what's going to happen and how this is going to go. I thought this was a funny little cartoon. I think that probably is how a lot of you feel. Is I just want to get this over with and know that things are still okay. But again, let's look at history. Let's try to get some semblance of how elections impact markets. Now, in full disclosure, I'll let you in on my own personal viewpoint here. A lot of the presidential cycle research that I've seen, it's valid, it's data, and it's historical occurrence. I personally don't put a ton of weight into it because I don't think presidential cycles and frankly presidents can move markets maybe as much as people give them credit for. But that's my own personal opinion. But how can the election possibly impact markets? Well, again, let's look at how stock market performance has gone based upon who has been in office. So this goes back to 1897. It's a long time. And so if you look at first term presidents, which is what we have now, okay, Democratic first term presidents in their fourth year, okay, there's been 8 occurrences of this. The average market return in that fourth year of an incumbent Democratic first term president, the average return has been 12.9%. And at 75% of the time, there's been up markets. Okay, this is an interesting little chart if you really want to dig into it. I'm not going to go through a ton of it. Somebody made the comment to me about, well, Biden's got a very low approval rating, which I think 37% was the last one I saw in December. It plus or minus now, I don't know. Well, I saw this graphic I thought was interesting as well. And what it shows is the lower your approval rating as a president, okay, generally speaking, has an inverse relationship on how markets perform. So you see this collection up here. This is a lower approval rating farther to the left. And farther up from this axis is the annual return. And so again, anecdotal maybe, but if you have a Democratic incumbent with a low approval rating, first term in office, I don't know what's going to happen with the election, but the data and the history shows that the market is likely to be higher. All right, so that brings us to, all that being said, let's summarize what 2024 might look like. And again, who really knows? We're just trying to make our best guess. I do think that lower interest rates will continue. So I think the rates will get lower. Don't hold me to this. I actually think there's an outsized chance that the 10-year Treasury can get below 3 in the next 6 months. If that happens, that's a very good sign for stocks. If that happens, more than likely, mortgage rates, all rates are kind of moving in tandem. Mortgage rates, the 10-year Treasury is probably the closest thing we have to base what mortgage rates are likely to be. And if that's the case, mortgage rates could get below 5. Again, I think it's possible. If that's the case, and you have a mortgage rate higher than that, you need to lock in. You need to be ready for it. Because I do think the long-term trend of rates is still higher. So something to be aware of. No bubble in sight. I don't think that's a wise indication of where we are. Valuations are not stretched. Market generally is around 18 times forward earnings. If you extrapolate like the largest companies that we just said that do have higher valuations, the forward earnings of essentially the rest of the market is closer to 15 times forward earnings. That's historically not overvalued. And if you get some of the economic tailwinds that I think could occur, that's a good sign. Election year, the trends favor stocks. Make that what you is. There are large amounts of cash on the sidelines, which helps the bullish case. And the the artificial intelligence super cycle, I believe, is underway. All right, so that's going to be kind of the short wrap up of 2024 and our thoughts. I do have a couple other things that I'm going to share very briefly, but I hope that helps. And obviously, as a follow-up, we're happy to answer any particular questions that arise. We are going through different types of portfolio adjustments really as we speak that align with this view. But let's talk about a few kind of more planning reminders and something just to be mindful of. Limits have increased, as they tend to do every year, on 401ks, IRAs, and such. I encourage you to go to our website, counterweightpw.com. At the very bottom, there's a key numbers guide. Steve has worked Very hard on this. This is one of his babies. He does an excellent job of updating all these numbers. Those numbers are updated now for 2024. They're live, they're active, and they're correct for 2024. I encourage you to take a look because it lists all these different key numbers that you should be mindful of. The other thing, health savings accounts numbers have increased as well. Remember, we love HSAs. For those of you who are still working and are healthy and have an HSA allowable plan, if you have questions on that, talk to us. We'll walk you through it. And here's some things to be mindful of right now at the beginning of the year. One, if you are someone who does backdoor Roth contributions, the beginning of the year is a great time to do that, right? The compounding effect of the time value of money, earlier you get the money in, especially with our view of what the market is likely to do, then you want to do that early in the year. Roth conversions. So for a number of you and a number of our clients, we're going through a lot of tax analysis every year, particularly through retirement and pre-retirement, to really reduce your lifetime taxation. Okay, and Roth conversions are a way and a method that we use to try to mechanically do that. Performing those Roth conversions early in the year, maybe we're not tippy top at the bottom, trying to max it out, but if we take some money, perform a Roth conversion earlier in the year, that's a great thing because, again, the time value of money, you've converted at a theoretically lower amount as markets rise over time. Make sure to increase your payroll deductions in your 401ks. I would bet that everybody we talk to says, yeah, I'm maxing out my 401k. When we actually get the data and we look at their payroll stub, I bet it's less than 50% are actually maxing. And usually it's because they don't think to increase them every year, right? Your payroll company or your payroll provider is probably not going to increase that for you. You're going to have a certain percentage and such. So now's a great time right now to go through and increase up to those maximum amounts in your payroll deductions. And then we're going to continue to hit this, but the Tax Cut and Job Act is expiring the end of next year now. And so we've got a 2-year window to take advantage of some of the taxation opportunities that it provides. Again, we don't know what the future holds and what Congress will do, but we have historically low rates right now. And so if you're someone who, maybe is going to sell a business soon, somebody that can project various amounts of income over time, estate planning, this is a huge thing with estate planning. So if you're a non-client and you haven't talked to someone about that, you really need to get on the ball there because it's something that is the window is closing. All right, and last few things, I promise. Oops. Okay. So a couple upcoming things I want to make you aware of. Number one, this replay of this presentation, if you're interested, will be available. It will be available on our YouTube channel. Just go to YouTube, Google, counterweight, probably wealth, you'll find it. And it's also going to be on our Insights page. So if you go to our website, /Insights, you'll see it there. Oh, wait, there you go. I'm looking at 2 screens here and they're not jiving together. Also, I'm very excited to say that we're going to host a Medicare specific webinar presentation on March 13th. Mark your calendars. This is for people who are approaching Medicare age. So if you're, I'd say maybe late 50s and early 60s, 65 is kind of the magic number for age for Medicare. And for also those people who are already either on Medicare or past Medicare age, I think it's going to be an extremely informative presentation. We have a subject matter expert that's coming in to really help give some guidance about a very complex government program. Mark your calendars for our next Clays to Raise sporting clay event benefiting the Raleigh Dream Center. That is May 3rd. And that's all I got. So thank you very much. We appreciate your time. If you have questions or thoughts about anything we've discussed today, reach out to one of us. We're happy to share. And wishing you a wonderful, happy new year. And I hope 2024 is a great year for each of you. We'll talk to you soon. Bye-bye.